All right. Also, we will be sending out all of the resources and the recording sometime next week. So you will get all the materials we talk about today. So this is just a look at some of the things we're going to be talking about today. As a note, we're presenting this information because we have a financial literacy program at the Human Services Center Mon Valley, but we also run a VITA free tax prep program. So VITA stands for Volunteer Income Tax Assistance, and it's an IRS certified program where our staff and we have trained volunteers who help the community complete their federal, state, and local tax returns for free. And because of that work and the things we've seen through the years, we want to see you all build good tax habits now so that can ease your stress whenever it comes time to file taxes in the spring, which is coming up faster than it seems like it should. One thing to note, VITA doesn't do all taxes. There are some things that we don't handle that are out of scope for us. So there might be some questions that we're not able to answer because we're not trained on that, and we don't want to provide you with the wrong information that you need. So we'll let you know if you ask a question that we're not sure of the answer to. Also, if this sounds super interesting and you're thinking, oh, I'd like to help people file their taxes, then reach out to me or Katie. You'll have our information because we're always looking for new volunteers for our VITA program. So we're going to be looking at completing the W-4, health insurance and taxes, receipts needed for tax credits, taxes for gig economy workers, and then, as I said, we'll have some time for our Q&A. So would you rather have a $3,000 refund or an extra $250 each month for your budget? So $3,000 is the average refund amount, and if you divide that out monthly, it's about $250 per month. And there's no right answer to this question. It's going to be a personal preference. Some folks like getting that large chunk of money once a year at tax time. However, others would rather have that money each month in their bank account to help pay bills when they're due and not have to wait to get it each spring. Also, whenever you get a refund, that means that the IRS has your money for that year, so they could be getting interest on that money instead of you having it in a bank account to get interest on. So you have to think about what works best for your situation, because some of the tax habits that we're talking about can lead to either having a larger refund or not having that large refund, but instead having more of that monthly money. And I will pass it over to Katie to talk about the W-4.
So the first tax habit that we are going to look at is making sure you have the correct W-4 form on file with your employer. So this is a form from the IRS, and what it does is when you give it to your employer, they know how much tax to withhold from your paycheck, and then, that gets paid to the IRS on your behalf. And this is for people who get paid on a W-2. So like myself and Annie, that's the type of work we have. If you're working at Walmart, any other type of company where you're going in and someone has a boss, like that's usually a W-2 pay. It is separate from self-employment type of income, which we'll chat about later. This form has existed for quite a number of years, but there was a recent change like 5 years ago, I think. We hear a lot at the tax site, folks say, oh, I claim so many number of exemptions on my W-4. That is not a thing anymore. So if you remember claiming exemptions for the number of people in your household, that doesn't exist. There's a whole new form. You probably want to make sure you have a new form filled out with your employer so that they're withholding the correct amount of tax. So instead of claiming exemptions, this is a screenshot of what this form looks like. For a lot of people, instead of writing exemptions, all you're going to do at this top part where the arrow is mark off whatever your filing status is. And that's usually, which is great. If you are married or you work more than one job during the year, you want to keep reading the form because there are extra steps that you have to do, which is we're going to look at. So the second step of it, it's a lot of words, I understand. So again, if you file with a spouse and you have similar incomes, lucky for you, you have this option that you can check the box on 2C. So this is like if you're both earning about $40,000 a year, if you check the box when your employers, and you both need to fill out one of these. When your employers put it in the system, it will do the math it needs to come out with the right answer. However, if you and your spouse have very different incomes, or you're a person who's working more than one job, what you need to do is then look at the worksheets that are part of this form that come after this step 2. And again, we're going to go a little bit line by line so you can see the types of things you need to fill out. So this is page 3 of what this form is, and the first part at the top that we're going to look at is if you've got 2 or more jobs or you're doing the married filing jointly, you are going to start on this first line that is here. And what it says is you're going to look at the charts that come after this page in the form, and you have to find some numbers and plug them into this line that is on the right-hand side of the form. So what that looks like is an example of one of the charts. I know it's a lot of numbers. I know it looks a little scary, but we're going to work through it. So for an example of what we're going to work on, this is the chart for married filing jointly, or if you are a qualifying surviving spouse. Qualifying surviving spouse means you have dependents and unfortunately your spouse passed away in the last 2 years. It's sort of a very specific tax filing situation. But in the example we're going to work on, let's say you and your spouse both work, you earn about $45,000. So what you would do, and we're going to say in our example, you earn 45 and your spouse earns 35. So you earn more, you are the higher paying job. So you look down the left-hand side to where your 45 falls, which is where this lovely little arrow is. And then you look across the top for the lower paying job because we said your spouse makes only 35. So then you find that in the column as well. And what you do is you draw a line down and across to figure out where these 2 points meet. So you look across your 40 to 49 line, and then you also come down from the top from 30 to 39. And what happens is they intersect at this $3,610. And what we're going to do is take that number, go back to the slide that we were just on and fill it in on that line. Here we have taken our 36,110. We have plopped it into the line that the instructions told us to add it to. If you work 3 or more jobs, or like between you and your spouse, there's 3 or more jobs, there's a couple extra steps on this form. But for our example, we're just working with 2. So after we have filled out our 3610 on this line, the other thing we look at is number 3, the number of pay periods for the year. So for our example, we are going to say that you get paid every 2 weeks, which comes out to 26 pays in a year. So that's what we have for number 3. Number 4 is just saying, take that number you found from line 1, divide it by 3, and put a number here. So when we divide out our 3610 into 26 pays, it comes out to $138.85. A little bit of rounding, but we're just going to use cents, not like thousands of cents. So you would put your 2 numbers on this line on the form. And then following the instructions on the actual form that you have, you also enter this on step 4C of your paperwork. That is what we have here. So this is step 4C. You would put it on your 138.85 on that 4C line. Now, of course, with any IRS form, it makes absolutely no sense why we went from part 2 to part 4 and then back up to part 3, but that's what we get to do because, of course, IRS makes sense like that. So we're backtracking a little bit. We go back to step 3. Step 3 is only going to matter if you would like to list out the credits you think you can claim for children in your household or other dependents. So if you know what those numbers are and you feel comfortable filling them out here, you're welcome to. If you don't feel comfortable filling out those numbers, you can skip this step and it will be okay. This is where you can list if you have a kid. So for our example, let's say we have one kid who is age 6. So that means they are under the age of 17. So we can list $2,000 on this line. Don't have any other dependents, we would skip that next line and then we would add our total here of $2,000. That bottom line also says you can add any other amounts for other credits here, which include things like education credits. You are welcome to do that if you feel comfortable and you know what those credits are. I will caution you that not all credits are a one-to-one credit. So for the Savers credit, which we're going to talk about a little later, just because you saved $1 in retirement does not mean you're going to get $1 off your taxes. So again, if that's not a thing you're comfortable with, it's okay if you skip that for this line. Also for education credits, things that we think should qualify for a credit do not actually qualify. The IRS has their own little guidelines they like to follow, and we'll talk about that a little later. So again, if you feel comfortable listing something here, you can, but you don't have to. And then going back to our step 4, if you can take some additional optional withholding here if you would like to. For example, if you did your own taxes last year and you owed money because you had a lot of bank account interest, or maybe you took an early distribution from your retirement account and you owed taxes because of that. And you plan to do those same things this year, and you know that you're going to owe about the same amount of money, you could list online for A what you expect that extra income to be. This does not mean self employment income, it's just other basic types of income. And what this does is when your HR people put it into the system does fancy calculations in the background to figure out if you have extra income, how much extra tax should they be withholding from your paychecks for that. So let's pretend like we have $500 that we would like to be paying. That could be listed on this line. So yeah, if we pulled out 500, we could list that here. Let's say we pulled out 500 from our retirement plan and we want to use our W-2 job to help pay that taxes. That's how you could do it in this instance. I will note it's not always wise to pull money out of our retirement plan because you pay a fee for having done that and you pay taxes on it. So you're kind of like dinged twice if you pull money out of retirement, especially if you're pulling it for something like a vacation or a frivolous thing that maybe instead we should just be putting money towards our savings account to pay for that. I know it's a little different if you have to pull money out for like medical expenses, but if it's something like a vacation, maybe rethink where we're pulling our money from. Or if you don't like doing this 4A of having to estimate what you think your extra income is, you have the option on line 4C of just listing extra tax you want withheld from your pay. So you could do something like decide you want an extra $25 withheld from your pay every 2 weeks. You could just write 25 here. So there's no fancy calculation in the background of the system when HR puts it in. They're just going to take an extra 25. So if you do these steps and fill out your W-4 now, what it's going to do is change all of your withholding going forward. So it'll change it for the next 3 months of 2024 to help pay any extra tax you think you may owe, or even just correct your withholding if it was incorrect. But it will also continue into 2025. So if you're adding this extra, maybe $25 a pay, and you're okay with that for the next 3 months, but you don't want that to happen after January, what you would need to do is submit yet another W-4 form to your employer that would take off this $25 line and just leave all of the other stuff listed on your form. Now, if everything I just went over, you're like, holy cow, I don't want to be doing this. It's a lot of extra steps. That's okay. As long as on the top of your W-4, you have listed that filing status, that is a great first step if you have not submitted a corrected W-4 in a while. Some instances on when you're going to want to submit a new W-4. If you are married now and you weren't the last time you remember filling out this paperwork, you probably want to submit a new one and indicate that you're doing married filing jointly. Or maybe you were married before and you are no longer for whatever reason. You would want to submit a new one that says you're single or maybe head of household if you have dependents that you're claiming. Or if you have a child that was a dependent and you've been filing head of household for a number of years, but they have moved out, moved on with their life, and they're filing their own taxes. If that was your only kid, or maybe it was the last kid in your home, you are no longer a head of household filer and you've gone back to being a single filer. You want to submit a new form to make sure that the correct amount of tax is being withheld. Because if not, what can happen when you go to file your taxes? If you did not have enough being withheld, you're going to end up owing the IRS later. Or if you just had a ton being withheld that you didn't need to, yes, it's great you get your refund back. But as Annie stated earlier, you could have also had that money regularly, monthly in your pay to help with your budget. On the IRS website, we will include this link in our follow-up resources, but there is a tax withholding estimator. This is a screenshot of what the beginning of that looks like, and it will let you click through and add information that is specific to your situation. So what filing status do you use? What types of income do you have? It will let you enter all of that information. In case you don't want to sit there and read instructions, this will give you basically the same answer on the other end. All right, now I'm going to flip it to Annie and we're going to look at health insurance and taxes.
Okay, before we move on, Katie, there was a question in the chat
Sure.
um, about head of household. If you can clarify if head of household includes a single parent with one child slash dependent.
Yes. So if you are paying, if it's just you in the household and you've got a kid under the age of, Annie, maybe you can help me with this, under the age of 18, unless they are 19 to 24, any full-time student, you can be head of household. You have to be paying more than half the cost of maintaining the home that you live in and more than half the cost of support for that person. So yes, you can be head of household even if you only have one child.
So moving on for health insurance and taxes. So if you receive health insurance that has been what we call Affordable Care Act insurance, ACA insurance, it might be called Marketplace, Obamacare. If you got it through Penny, which is the Pennsylvania specific marketplace, that's what we're talking about in this slide. What happens is that part of the total cost of your insurance is paid for by the government, and then you pay a portion of it as well each month. What is sometimes unclear is that that insurance payment from the government on your behalf is actually a tax credit that is paid to your insurance company on behalf of you. So it is considered a tax credit. With many of our tax credits, the amount we receive is dependent on our income, and this is the same. So the amount that we receive towards our health insurance through Penny, through the marketplace, is going to depend on your insurance. So we want to make sure that we're accurately reporting our income on the application website whenever we get our health insurance, and we're updating it so we can have the correct amount of tax credit applied to us. If we would, for example, underreport our income and saying that we think we will make less in a year than we did, say you thought you'd be making $30,000, but you got a much better job than you anticipated, now you're getting $50,000, then you are going to owe money back to the IRS for the money they paid towards your health insurance because you made more than you anticipated. And likewise, if you overestimate what you think you would make for the year, you could potentially get a slightly larger refund since you didn't get all of the tax credit money monthly. This can happen if you lost a job, whether by your choice or not, or maybe you were working and had to retire, you took a pay cut for some reason. Regardless, we want to make sure that we're keeping our income updated to the best of our abilities on Penny through that marketplace. So we are getting the correct amount through the government payment to our health insurance. So at this point, with most accounts, they're going to be through Penny if you're living in Pennsylvania. So you want to call them or log on to your online account and update your income as needed, whether it's an increase in income or if there's a decrease in income or a change in a status, which I think we talk about next. So we want to make sure we're updating our health insurance information with changes, including an addition. So if there's a birth in the family, an adoption, if you're married and you're now filing jointly or you're on health insurance with your spouse, and removals if there's a divorce, if someone died, or if a child is turning older than 26. And so a note on that, your dependents for your health insurance are different than who counts as a dependent for your taxes. So a child up to age 26 can be listed on a parent's health insurance. Even if they're not dependent on your taxes, they can still reap the benefits of your health insurance. So that's one thing to note whenever we're looking at health insurance and how that affects our taxes. And if you receive insurance through the marketplace, then you must file a tax return to kind of look at this credit and make sure that you receive the correct amount. So Penny will provide a form called the 1095-A that must be added to your tax return. If you don't get it in the mail, you can call Penny or go onto your online account to look for it before coming in for your tax appointment or going to your preparer or doing your own taxes. For our Vita sites, whenever we've had folks who had marketplace insurance but did not bring in their 1095-A or didn't let us know that they had it, then the system would reject the return until we added it, which just really caused a huge delay in them getting their refund. So next we're going to talk about receipts needed for tax credits. So there are a variety of things you can claim a tax credit for, and a lot of them want to see receipts or a specific tax document to support it. So we're going to go through some of the more common tax credits that we see and things that you might need to prepare those receipts for. Building a good tax habit is educating yourself about what you might qualify for, and also making sure to keep those receipts, get copies of paperwork you may need, and storing them somewhere safe so you can find them during tax season. So we're going to look at child or adult care, retirement contributions, educator expenses, tuition and school expenses, union dues, and work uniforms, and gambling, winning, and losses. So for child or adult care, there is a tax credit called the Child Independent Care Credit that you may qualify for if you had a child or adult dependent in one of the care options listed here while you were either attending school, looking for a job, or working. So if they were at a child summer camp, before or after school programming, daycare, or an adult daycare. So, in order to claim this credit, your tax preparer will want you to bring that receipt with you from the agency that you paid, stating their contact information, their federal ID number, the amount that was paid, and the person it was for. Even if you have someone who is a family member, but you are paying them to watch your child, you still need some kind of information from them stating that you paid them for childcare, and you would need their social security number, and they would have to report it as income for you to be able to receive this credit. So, whether you think you qualify for this credit or not, just make sure you're getting the paperwork and your preparer can help you sort it out. They'll likely send it to you after December 31st, but definitely ask for it in January in anticipation of filing your taxes. If you used an agency earlier in the year and you aren't using them now and don't plan to before January, like for example, maybe your kid's summer day camp that you paid for, you can reach out to them now and see if they're willing to give you the form in advance. Another thing to note, this is a non-refundable credit, meaning that it can help pay for the tax you would owe to the IRS, but it won't increase your refund or create a refund if you weren't already getting one. So if you were owing taxes for some reason, this is a great way to reduce that number, but it's not going to get you an even bigger refund. Next up, we have the retirement contributions. So any contributions to some of the retirement plans we have listed here can help you earn the Savers credit. So if you contributed to a work retirement plan like a 401k or a 403b that you contributed to through payroll deductions, it should be listed on your W-2 come January. If it's not, you can check your last paycheck to see the total you contributed. For a Roth IRA, or which is a personal retirement plan, you're able to contribute with your own money after you've received your paycheck. So you want to keep track of how much you have put in during the tax year. Some companies only send you the total receipt after April 15th, but this isn't really helpful if you're filing your tax return in early February. This is another one of those credits, like Katie mentioned, that's not a one-to-one credit. So that means that for each $1 you contributed, you're not going to get $1 off of your taxes. But if you are contributing, you might as well list it to get some money off of your taxes. And again, this is also a non-refundable credit. So it's going to be another one where it will decrease the tax that you owe, but it won't increase your refund. If you have one of these accounts and you haven't put anything in it this year, there is still time. So you can ask your employer about starting contributions to a 401k or a 403b and inquire if they do contribution matching. Or you can log into your Roth IRA account and see how you can make a contribution, whether it's one off or considering setting up a monthly contribution. Next up, we have educator expenses. So if you just bought a bunch of stuff for the classroom, you want to keep your receipts. Educators can claim up to $300 in expenses, up to $600 if you're married filing joint and you're both teachers. This qualified expenses include professional development if you attended a conference or a webinar or something that you paid for to learn more about educating, any books that you bought, classroom supplies, computer equipment, including software and services, and any supplementary materials that you use in the classroom. We also have PPE, disinfectant, and other supplies used for the prevention of the spread of coronavirus are all things that can be included in those educator expenses. You might qualify for this if you're a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide, and worked for at least 900 hours per school year in a school that provides elementary or secondary education. These deductions are subtracted from your income, so with less income to tax, you pay lower tax. And then we have tuition and school expenses. So if you are in a college or a professional development program, or if one of your dependents on your taxes are in college, there are tax credits you can claim related to those educational expenses. This usually involves tuition and fees, lab equipment, if you took anything like a chem class, and required books and materials. Unfortunately, room and board or meal plans are not included in this, nor are parking passes. Computers aren't included in this unless you have a syllabus or something else from the school saying it was required for admission or for a class. And your school should send a tuition statement or a 1098-T after the new year showing what you paid, and it will also list your scholarships. But what you want to do is make sure that you know where all the receipts are for all the textbooks you bought. Often at our tax site, folks have their tuition statement, but they can't remember what they spent on books, so we can't get them a higher credit. So you want to make sure that you're keeping track of the money you spend on textbooks. I mean, we know those can get really expensive. If you already have your school degrees and you took a certification course for your job or continuing education that you paid for, you can also claim those expenses with the lifetime learning education credit. So you can get a max credit of $2,500 per eligible student per year. If the credit brings the amount of tax you owe to zero, you can have 40% of any remaining amount of the credit up to $1,000 refunded to you. So it's a partially refundable credit. Union dues and work uniforms. These are some expenses that you can claim on your state and local income tax return. If you paid union dues or if you had to purchase special clothes for work, you can write those off. Some W-2s, but not all, will list what you paid to the union on it. If you aren't sure if yours will, make sure to keep the final pay stub of the year, which shows the total payment. Or if you paid with cash and not through payroll, please find and keep that receipt showing that you made a payment, and make sure that you know the name of your union. For clothing, this has to be clothing you can't wear on the street. So if your job requires that you wear khaki pants, those, even if you hate khaki pants and you would never be caught dead in public in a pair of khaki pants, they are still technically clothes that you could wear in public, so it's not deductible. But something like scrubs or a shirt with a company logo, steel-toed boots, things like that can count towards this uniform costs. Also, the cleaning or repair costs for those items can count as well. You can also deduct the price of tools you were required to buy or a professional licensure you were required to purchase, as long as your work hasn't reimbursed you for any of these items. You'll want to collect and tally your receipts for these things. And as a note, we're not going to go super in depth into this. So these are only deductible on the PA and local tax returns, as we mentioned. If you are self-employed and you also pay to be a member of a union, then you can deduct your union dues on your federal return as a business expense. That's a pretty specific case, but we just wanted to point that out as well. And then we have our gambling winnings and losses. So you are required to report your gambling winnings to the IRS and to Pennsylvania. It counts towards your income, and you don't want to get in trouble for leaving that off your tax return and leaving off any casino wins, because if the casino reported that income to the IRS, then the IRS will know that you didn't list it and they will ask for the taxes you owed on it. A casino or the PA lottery may give you a W-2G if it was a large single transaction win. If not, you should keep any winning lottery tickets to show the amount. Casinos can also give you a printout of the total wins on your card. You also want to track your losses because that can help to offset your wins. So for losses on the federal tax side, you have to itemize your taxes in order for that to be a write-off. So you might not have enough casino or gambling losses, or just things that you're itemizing for that to be worth it. So we have seen at our tax site folks who gamble a lot who have lost enough money to itemize, but some have not. For PA, it's a lot easier. If you have losses that add up to your winnings, you can deduct them all. But we're going to want to see something proving that. So you want to keep any losing lottery tickets or the printout from the casino, whether it's a W-2G or the individual slips you get that show what money you lost at the casino. And I think with that, I will pass it back over to Katie.
Yeah, so we're going to look at things that matter for gig economy workers. And that phrase, gig economy workers, means people who are like driving for Uber or Lyft. Maybe you're doing deliveries for Instacart or DoorDash. It's that type of situation. A lot of what we're going to share can apply to other self employed folks. So if you do something like sell your crafts on Etsy, or maybe you're selling clothing on Poshmark or eBay, a lot of this the same information will apply because you don't have a boss that you're working for and a company that is tracking things for you. It is your responsibility to track this information yourself. So this includes tracking your income. Are you getting paid in cash? Are you getting paid through an app or a website? And then also, what expenses do you have? Any company that is collecting money on your behalf, so if you've got an app that you're getting paid through, or even like the eBay website is collecting payments on your behalf, they should send you what is called a Form 1099-K if you received over $5,000 in payments on their platform. You may also receive a 1099 NEC if you received over $600 in slightly different income. That includes referral bonuses, miscellaneous payments they happen to make for you, or any promotional credit that you earned. So you might have both of them, or you might only have the 1099-K if you didn't do referral bonuses and promo credits. You also may not receive a form if your income was below those two levels, the 5,000 for the K and the 600 for the NEC. Even if your income was below the levels for a form to have been produced for you, the fact that you still earned income means you still have to report that income. So that sometimes confuses folks. They think, oh, I didn't get a form. It is free money. It is not free money, and the IRS wants the taxes related to it. So, whether you think you're going to get a form or not, a good tax habit for yourself is to start tracking how much income you're earning. You could do this monthly if you are not wanting to track it monthly, but you're willing to do it quarterly, which would be every 3 months. You could do it quarterly. Or, if you did a couple gig jobs during the year at different times, you want to be tracking what you were getting during those different times of the year. If you're doing it through an app, you can see what sort of income is coming in monthly. If you're doing anything in cash income, you should really start writing things down because you need to know how much is coming in on that regular basis so that when you come to file your taxes, we know what income to be reporting on your behalf. So check your app, check your website, or start writing things down on paper, whether that's like physically writing on paper, or maybe you keep a spreadsheet if you've got Google Drive and you just want to type things in on there. Any way you're tracking your income is going to be better than not tracking your income at all. You also need to track your expenses. You are required to list whatever your expenses were related to this income that you earned. And in a lot of cases, you want to list those expenses on your taxes because what it does is they subtract your expenses from your income. You get what is called your net income, and then you're taxed on a lower amount of money, which means you're going to pay a lower tax rate, which is great. If we can prove that we have these expenses and it means we owe less tax, it should be something that we want to be doing. So on our screen are examples of some of these expenses. This is not the entire list, but we only have so much space on a slide. If you're doing any driving, we're going to track our mileage. If that driving included paying really expensive tolls on the PA Turnpike, please be tracking those as well. You might be buying office supplies for yourself. You might be buying boxes and paying postage to mail things to people. A lot of these apps and websites are going to charge you fees for using their platform. So track all of that. If you're doing any driving and your car insurance company has said, hey, we want you to carry a higher insurance, track whatever that is because it is related to your business. For your cell phone, this is like one of those tricky calculation things we get to do as tax preparers. If you have a cell phone that you only use for this self-employment income and you don't do anything personal on it, we could list potentially your whole cell phone bill. Most people don't carry around two cell phones with them though. So you're probably doing this work on your personal cell phone as well. And what we need to talk about when you come for your tax appointment, hopefully you will have thought about it earlier, but we will at least talk about it at your tax appointment. Roughly how many hours a week are you doing this gig work compared to, how many hours a week are you using it for personal time? And what we do is take a percentage of your cell phone bill and we can put that as an expense. It won't be the whole thing if you're using it for personal stuff as well, but at least something is better than nothing. So you want to track any fees, anything you're spending money on, track that. If the platform is withholding anything from your payments, track what those sorts of fees are. When we send out resources, we will send you our self-employment tracker, which has some little boxes and descriptions of things you can start paying attention to keep track of. If you realize you're paying for something that's not on the list, that's okay. Add that as well, because you just want to have a good idea of what expenses you're paying. And this is one of the reasons we did this presentation in the fall before tax season, is because you at least have 3 months to be able to track all of your expenses if you've never done this before. And that is better than us trying to present this during tax season when you've lost the opportunity to track anything during the year that you're paying the taxes for. So anything you can track during these 3 months is better than nothing. You also will probably remember better now what you may have been doing earlier in the year than come March when you file your taxes. You may not remember at all what you did in the previous 12 months. So if you can go back in time and rebuild any of your receipts or documentation of things you paid, that's great. But if not, at least 3 months going forward, you're going to have a really good expense tracker. And this is a quick note on mileage because this is a confusing thing we see at our tax site a lot. There are three different types of mileage, and you want to pay attention to this because they mean different things. So there is commuting miles, which means when you have left your house to, if you're an Uber driver, where you drove to pick up your first person, or if you are doing food delivery, leaving your house to the first pickup location to pick up that food. Your business miles are what you're doing, driving that person around to wherever they need to go, maybe driving between dropping person one off and picking up person two. So it's that driving actually during your routes. And then commuting miles come back in after you've dropped your last person or meal off at the end of the night and you're driving to your house. And that's the same as me leaving my house and driving to my office. I also have commuting miles. Your commuting miles just look a little different. And then we all have personal miles. This is what we're doing, driving around doing our own errands, driving somewhere on the weekend, not remotely related to work or getting to a place where we're doing something for work. Unless you have a car that literally all you're doing is using it for your gig work, you're probably going to have personal miles related to it. If you're using an app for any of your gig work, it is likely tracking your business miles, which is really great that it's doing something. But a lot of systems that are used, like I know our website system that we use for entering taxes, we need to list something in like all of these boxes for commuting, business, and personal. And if we don't have the information, we have to sort of backtrack and recreate something, which may not mean it's the most accurate for your taxes. So, as you're tracking your mileage, please don't only rely on your app. Try to think about these other things as well as you go. And then I think this is sort of the last thing we'll look at is actually paying taxes related to being a gig worker. So the IRS specifically states that taxes must be paid as you earn or receive income during the year. So again, if you've got a job working for a company, that tax has been taken out of your pay and sent along to the IRS on your behalf. But since you're a gig worker and you're not working for a company in that same situation, you don't have someone being responsible for that and doing it for you. So you have to do that yourself. And that is called your quarterly estimated taxes. It is estimated because we are estimating how much income we think we're going to have for the year and then making a payment related to that. Once you file your actual tax return, that was your real income. It's not estimated at that point. But to do this, there are two related forms. So it is Form 1040 ES lots of letters and numbers with the IRS, but if you're going to Google it, you want Form 1040 ES. That helps you calculate the amount that you have to pay related to what we are estimating our income is going to be. And then at the end of that document are payment vouchers. So it's a 1040 ES payment voucher. And what it is a third of a sheet of paper that you print out, include it in an envelope with whatever payment you are sending along. Or you can do these payments online in your IRS account. So there's two forms, they're related to each other. One is the actual form to help you calculate it, the other is your payment voucher. And I know IRS forms can be very overwhelming because it's a lot of text. It's a lot of start here and then go here and come back to the beginning. Like we saw with the W-4, you did part 1 and 2, ended up in 4, and then went back to 3. That can feel very overwhelming and confusing. I understand it because I had to put that together for the presentation. But as we did earlier in our presentation, if you just look at it piece by piece, they actually do describe very well what you need to be doing. So when you get your 1040 ES, just go piece by piece reading those instructions and follow along what it says to do. If you need to refer to some chart to do a calculation, that chart is usually listed later in the form. You don't often have to go figure it out on your own. They usually give you everything you need, except for the income pieces that you have to add for yourself. And again, once you have figured out what your quarterly estimated amount should be, you can make that payment by mail or do it online. Now, if the work you're doing this year is very similar to the amount of work you did last year, you're earning about the same amount and you expect to continue earning the same amount. What you could do is if you know that you owed $1,000 last year and you feel comfortable with it, to skip the calculations because you know your income is going to come out the same, you could just take your 1,000 divided by 4 if you feel comfortable doing that. But it's always best to try to work through the calculations because some calculations of things they let you deduct do change over time. And there are some websites that will help you with that. So this is an example of one of the websites. This is from one of our partners called the Get It Back campaign, and it has two options on how you can calculate your estimated payments. The simplified one just assumes that all of your income is from self-employment income. You literally pick a filing status for yourself, as you see on this screen, type in what your self-employment income is estimated to be, and it pops out a number for you. There is also an advanced version, which think has 8 steps, but it's not that bad. I played around with it this afternoon. Again, you're going to pick a filing status. It wants to know your self-employment income, but it also lets you say if you have income from other sources like interest for a bank account, or maybe you also have a W-2 job and taxes were withheld from that job. It lets you enter all of that information, helps you with a little calculation to estimate what they think your tax is going to be that you owe. There are quite a few of these websites that help you calculate this. I looked at multiple of them in preparation for this. I am always going to recommend a partner that we've worked with before, which is why I put Get It Back on our screen, because they've helped with some education materials in the past that our site has referred to. But also, anything that's on the IRS website as a tool is going to be a lot more accurate than things you find on other websites. So if you are just going to do some Googling on your own, you're welcome to do that. Just think about the source of where some of the information is coming from. And our follow-up resources will include the link for this calculator if you would like to play around with it yourself. Oh man, that's not appearing on my screen. This is supposed to be a cute little chart of when your payments are due, but payments for gig economy workers are usually due on the 15th day of the month in April, June, September, and then January of the following year. So for this year, 2024, for the income you earned in 2024, we should have paid our first payment on April 15th, the next one on June 17th, the third on September 16th, so we just missed that one. And then we have till January 15th in 2025 to make that last payment. Now, like I said, it's usually due on the 15th of those 4 months. If the 15th falls on a holiday or on a weekend, they just bump it to the next business day. I would still recommend if you're mailing a payment, mail it well in advance of that, just because. So again, the last payment we just missed was on the 16th. That's okay. You've still got time to make one more payment in January if you would like to do that for that income that you have been submitting this year. Also, if you just started doing this work and you hadn't earned any money before the 16th, that's also okay. You would just make your next payment then around January 15th. That was everything that we had on our agenda. So I'm going to stop my screen share so I can also look at our Q&A and look at some of the questions that were submitted ahead of time for us. Annie, was there anything left in the Q&A that we specifically needed to talk about?
I don't believe so. There were a couple specific questions. One that I was doing a little research while you were talking, but I'm going to bring it up just in case I was wrong or you know something I don't know. Um, the educator expenses credit. Someone asked if that counts for GED teachers, which through my research, I saw that it was only K through 12 teachers specifically. But I just wanted to check with you in case you had any info I couldn't find.
Yeah, I've always heard it in reference to the primary and secondary, which usually means elementary school and then junior and senior high school, so K through 12 people. So likely not unless you've got, I don't know, like if you're an actual employee of a high school and you also happen to teach GED, that might be a little different. That might be something we need to look better on the IRS website for you. I've never heard it in reference to that before. And I will say an extra little tidbit with that. If you and your spouse are both educators and you both have receipts, you could claim up to 300 if you spent up to 300. If one of you spent 100 and the other spent 500, you can't claim the whole 600. You only get 300 per person. So that also sometimes comes up. But again, just bring your receipts in. Your tax preparer can help you figure that one out. All right, I'm going to check our Q&A that was submitted on our registrations. Because I know one person had a question about OTC meds, and I think I saw that you were on the call tonight. If you're itemizing your taxes, you can use medical expenses as a write-off. I will say those expenses need to be more than 7.5% of what is called your adjusted gross income, your AGI. So if you have spent more than 7.5% of your income on medical things, that counts for itemizing. However, over-the-counter meds don't qualify for that. It usually has to be prescription meds that a doctor has like signed off and like sent to the pharmacy for you. But if you have an HSA or an FSA account, those are handled a little differently. You can sometimes use those to pay for OTC meds. And again, that would be a thing. If you have pulled money out of your HSA or FSA to pay for that, just keep your little receipts handy in case that is something we need to add onto your taxes for you.
We did have another question coming through the Q&A, and if anyone else keep throwing them in there, we've got time to answer questions. Someone asked if receipts, in parentheses, gambling, education expenses, etc., total is less than the standard deduction, then the standard deduction is used, correct? And that really depends on the expense. So for gambling expenses, that's one that if your losses are less than the standard deduction, then that wouldn't come into play. But for the education expenses, those reduce your income, right?
So education expenses are completely separate from the standard deduction. So you can take the standard deduction and still get help on your taxes by listing your education expenses, your tuition, your books. Yes, gambling, at least on the federal side, does fall under, are you going to take the standard or are you going to itemize? And I know for 2024 taxes, if you are single, I'm sorry, it's the only number that I have memorized. I know that amount is 14,600 is the standard deduction. So if you have gambled a lot and you've got like $20,000 in losses, it would benefit you more to itemize and list that plus any of the other things that you might qualify for itemizing. If you had like $50 in losses, you probably don't have enough of the rest of the stuff to itemize, and taking the standard would be better for you. There is a question in here. Can you get help filing taxes for 2023? Yes. If you come to something like a VitaSite, we can do up to 3 years worth of taxes. You would want to find any of the paperwork related to 2023 and bring it with you. So your old W-2s, if you've got self-employment, recreate those expenses and income the best that you can. Pull any receipts, any of the forms related to things that we talked about tonight and you might be wanting to claim. If you have an account on the IRS website, which is irs.gov, you set up your account through what is called ID.me. You have to like show a photo ID card to like match who you are, matches who's on your photo ID, but you can get an IRS account. You can pull a tax transcript off of there, which has a lot of this information, even if you can't find all of your old forms. You would want to pull a transcript that is what is called unredacted or unmasked, which they sometimes like hide EIN numbers, which are just like what is the company's social security number, for lack of a better idea of what to call that, their identification number. But we need that to enter into a lot of the online systems. So ask for an unredacted copy, bring it in with you. If it's not quite what we need, we'll help you figure out how to get what you do need. You can also, if you have a tuition statement from a school, go back to, I don't know if that's your financial aid office or the billing office, ask for the copy of a previous year tax return or tuition statement, and they should be able to get that to you. Can we remind you the qualifications to have your taxes done? I actually have not heard of the income limit for the coming tax season. I won't lie. Last year, I can say if there was one person on your taxes, you needed to make under 45,000. If there were two or more people, whether that's you're married and you file jointly, or you file as the only adult and you've got some dependents, you can make up to, I think it was 65. Those numbers usually go up a little bit each year. When we email out how to get an appointment in January, that information will be included so you know if you qualify for not. Also, all of the scheduling goes through United Way if you call 211. So if all you remember is call 211 in January, they will help you figure out if you qualify to come to a VITA site or not.